Okay, so there is the piece of advice that has been floating around personal finance for about 15 years now. And it goes, don't pay off your mortgage early. Invest the money instead. The stock market return more than your interest rates. And for a long time, like 2010 through 2021, that advice was basically right. Mortgage rates were low, the market was doing well, it made sense to invest. But problem is, a lot of people are still saying it like it is 2019, and the numbers have actually changed pretty significantly. So I'd want to go through this properly with what rates actually are right now in 2026 and be honest about where I think the standard advice holds up and where I think it doesn't. Because at 6.4% mortgage rate, the question of invest or pay off is genuinely close in a way it wasn't a few years ago. And I think most content on this topic is running on outdated assumptions. Right, so let me just do the numbers fast so we are all starting from the same place. 400,000 mortgage, 6.4% interest rates, 30 years. Your monthly payments is about 2,500. Over the life of that loan you will pay, and this is the number that usually gets people, about 500,000 in interest alone. So you will have paid roughly 900,000 for 400,000 loan. And this is just the math. I'm not saying it to be dramatic. It is just what 6.4% over 30 years does. Now the stock market. S&P 500 has averaged about 10% annually since the late 1950s. After tax, probably 7 to 8% in real terms depending on your situation. So the standard argument from finance advisor is 7% investing beats 6.4% mortgage. Invest. That is technically correct in expectation. But I want to push on that word expectation for a second because I think it is doing a lot of work in that sentence that people don't notice. When people say the market returned 10%, what they mean is average across the last 60 years, including the 1950s post-war boom, the technology revolution, the global financial expansion. The average comes out to about 10%. That is real. That is a real number. But there is one question worth asking, which is, do we have good reason to expect the next 30 years to look like the last 60? And I genuinely don't know. Nobody does. But I know that US stock market valuation right now, measured by something called cyclically adjusted price to earning ratio, the CAPE, are at about 39.6. And that is the second highest reading in 155 years of data. The only time it was higher was the dot-com bubble in 2000. Okay, but CAPE doesn't predict when the market crashes, of course. It is not the precise. What it does predict reasonably well is long run return from a given starting valuation. And at 39.6, the implied forward return according to GuruFocus valuation model is about 1.7% per year. Not 10. 1.7. And if that implies return is even roughly directionally correct, then invest instead of paying off your 6.4% mortgage is no longer an obvious call. It might even be wrong. Now I want to be clear. I'm not saying don't invest, of course you have to invest. I'm saying the gap that people assume exists between mortgage rates and stock returns is smaller than it used to be. And some people are making financial decisions based on gap that might not actually be there anymore. And there is one more thing about mortgages specifically that I think most people don't fully clock. The effect of paying is not the same throughout the loan. It depends on where you are. In the early years of your mortgage, years 1 through 10 or so, your remaining balance is high. So the interest charge every month is high. If you make an extra principal payment in year 3, you eliminate not just the chunk of principal, but all the interest that would have compounded on it for the remaining 27 years. The saving is genuinely large. Same 10k, year 3 save you 46k, year 25 save you $4,500. So if you are at first decade of mortgage at today's rates, extra payments are punching significantly above their wave. The standard rates comparison misses this completely. Late in the mortgage, the bank has already collected most of their interest. Extra payments matters much less. At that point, investing is probably better. Okay, and here is where I want to say something that finance people don't really like saying. Whether you invest or paying off the mortgage might matters less than whether you actually do either one consistently. The US savings is 3.6% right now, which means the average American is barely saving anything at all. And most personal finance debate happens as if everyone is sitting on significant excess cash trying to optimize it. But most people are. Most people are trying to just get through the month. And within the group of people who do have extra money, a lot of them will invest it. Push the market drop 20% in year one, panic, pull it out, and effectively earn nothing. Or they will make 2 extra mortgage payments, feel good, stop, and go back to normal spending. The optimization only matters if the behavior is consistent for years. And I'm not saying this to be discouraging, I'm saying it because I think sometimes the focus on which option is 1% better mathematically is a way of avoiding the harder question, which is, will I actually follow through on this for a decade? So where does this leave me? If your mortgage is under 5%, probably still invest. The gap is real even accounting for lower expected returns. These rates are cheap money. If you are at 6 or 7%, which is most people who buff off refinance in 2 last years, I genuinely think this is close enough that your personal situation matters more than the math. How stable is your income? How much liquid savings do you have? How would you actually handle a market drawdown? Answer this first. About 7%, I prioritize the mortgage. A guaranteed 7% return is hard to beat when you honestly account for tax and volatility on the investing side. And there is a separate point about timing. If you are early in your mortgage, first 10 years, extra payments are more powerful than the rate comparison suggests. If you are in the last few years, they are much less powerful. So invest. And one thing I'd push back on through. The idea of paying off debt is somehow financially naive or emotional rather than rational. I've seen that framing a lot, and I think it comes from a period, roughly 2010 to 2021, when rates were so low that holding debt was obviously correct. That period made people overconfident about very specific environment that is no longer exist. At 6.5% guaranteed return, paying off debt is not irrational. It is actually a pretty good investment. Me personally, for what is worth, I've been thinking more about the CAPE number lately. 39.6. Historical average is around 17. We are at more than double the long run mean. This is not a crash prediction. The market was expensive in 2017 too, and it keep going. But it does mean the expected return from here is probably not 10%. And once you accept that, the guaranteed 6.4% from paying off debt looks a lot of more competitive than most finance content will tell you. Not selling everything, of course, not changing my whole approach, just the math looks different now than it did in 2019, and I think people should at least know it before they decide. So this will be everything for the video. I hope you like it. If yes, leave me a like and subscribe, and if not, leave me a comment. I read everything.